So now let's discuss one of the most important fundamental principles of investing today, which is called the asset allocation. To understand this, you have to find out what is an asset. Asset is nothing but an investment venue which you expect to repay in a future date. And allocating your money across these assets is called asset allocation.
Well, asset allocation is a factor of your risk profile and your risk tolerance. It tells you whether you're a conservative investor and therefore what should be the proportion of money that you should have invested in risky assets vis-a-vis conservative assets, and so on and so forth. Which is why investment decisions should never be made in part or piecemeal. Rather, it should be a cohesive decision as a whole, which should be in line with the goals that you're setting out to meet.
To understand asset allocation better, let's take an example. Every time you take a financial investment decision, you're actually taking three sub-decisions. For example, if you wish to buy a property, you have decided the asset, which is real estate. Second, you're going to specifically choose an apartment to buy in this case. Third, you could have bought it 6 months earlier or 6 months later. So you have an asset allocation decision, the product selection decision, and the timing decision. Research clearly points out that 90% of the fate of your money will depend on choosing the right asset, not the product and the timing of it.
So Firoz, if the fate of anyone's wealth depends on asset allocation, can allocation also incrementally increase the amount that you're going to earn?
Yes, it can, because different assets have different attributes. For example, a physical asset like gold could actually have a hedge against equity, in turn protecting your downsides and keeping you afloat for a further growth in the subsequent years.
But you know, Firoz, when we talk to investors, a lot of them actually talk about individual funds, right? Or individual assets. Not a lot of them talk about the composite whole. Therefore, in your experience with clients, what have you gathered about where people are actually investing and what kind of asset allocation do they follow?
See, we as Indians, if you look at research in terms of household savings, getting into different four most important assets, in the chronological order of allocation would be real estate, then gold, then deposits, and finally equities. So much so that Indians actually have 60 to 62% of their total savings into physical assets. Globally, that number is as little as 18%.
So Firoz, you know, there are a lot of yardsticks for asset allocation, some of them based on age, etc. Would you recommend people using them?
Yes, I think age is a good indicator of your risk-taking capability because the future earning potential is lower as you progress in life. The indicative asset allocation between the two financial assets of equity and debt would be, for the age group of 25 to 35, 70% equity and 30% debt. For the age group of 35 to 45, 60% in equity and 40% in debt. For the age group of 45 to 55, 50% in equity and 50% in debt. And for the age group of 55 to 65, 40% in equity and 60% in debt. These are thumb rules looking at the contemporary situation of equity and debt. But asset allocation is something which is a very customized variable, and one size fits all doesn't work on this one.